new lows for the market in the immediate future. Why are you saying that?
Good morning, Stuart. Well, you know, financial crises and recessions are two separate things that sometimes happen at the same time. So like in 2008, they happened at the exact same time. And we're seeing that begin right now. I think it would be a major mistake for us to think that we're just somehow out of the woods on this banking crisis stuff. Because, you know, when we look at Lehman to Bear Stearns, the failure of Fannie and Freddie in 2008 and 9, that developed over 1 year. We're in the first 1 month right now of watching this thing unfold, and we've seen record amounts of stimulus and cash pumped into the system all at one time. And so if you're asking me right now, no, I don't see a very bright and rosy picture in front of us. In fact, what I believe that this is going to be called is the Federal Reserve bubble, because what the Federal Reserve has done is they've hiked interest rates up so fast after printing 80% more money just since 2020. And so we're sitting here, tons of cash in. This has, you know, caused every IPO to occur, every venture capital deal. That propped up the stock market, that propped up the bond market, and ultimately the real estate market. We've got bubbles in all of these areas right now, with the massive debt ceiling debate that's coming out and the political gridlock.
One of our commentators this morning said that if the Fed does raise rates by 25 basis points this afternoon, as expected, you could see a very sharp rally for the stock market. Maybe 5% in the next couple of days. You're twiddling your thumbs, you say, ain't going to happen?
I'm going to say, you know, I don't know. I mean, I vote the market goes up forever. I think if the Fed paused right now, we're for sure going to have a rally. That hurts his situation. If we see the, you know, the interest rates go up, you know, we're at a point of do or die here. This is a make or break moment, and how the Fed responds and what we do, you know, that's ultimately you know, what the world's paying attention to. But they're telling us exactly what they're going to be doing, and they're hiking us into a recession today, and it's big issues.
So, David, for the last 3 months, I think you and I have been in sync in suggesting that maybe you go to short-term treasuries for safety and security. We're still there?
Yes, sir. I do want to just caution people against going into bonds right now, because the bond market is 3 times larger than the stock market. And if we see major challenges, specifically SVB had issues because interest rates rose and the value of their bonds had these major losses. They just didn't have to mark to the market and show their numbers there on paper. And so be very concerned about bonds here today. But yeah, cash sounds great. And also there's alternative options to bonds like growth-oriented fixed index annuities that, in my opinion, never been a better time to own them. Market goes up, you make the majority of the gain. Market goes down, none of the pain.
That sounds interesting. I think I can vote for that. David Stryzewski, thanks very much, sir. We'll see you again soon. Thanks a lot. Okay.